Hi, everyone. Thank you so much for coming and joining us today. I'm Marche, the webinar director here at Advice Chaser, and I am very excited to have you here. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own and, however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we are thrilled to bring you today's educational presentation, and we're excited to have you participate as well. Attendees are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries after the webinar today during our question and answer portion today. If you ask a question in the chat box, go ahead and leave your phone number as well. And if we can't get to your question during the event, we'll make sure someone else reaches out to you after today's event. Once again, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd like to introduce you to today's presenter. Ransom H. Adams is a partner and wealth plan manager at U.S. Capital Wealth Advisors and also earned a bachelor's degree in financial planning from Texas Tech University. He holds a designation of certified financial planning professional and has over 15 years experience in the financial planning world. Outside of work, Ransom is a husband, father, and an Eagle Scout. Ransom is based in Austin, Texas, but serves clients throughout the United States. And Ransom, we're really excited. We have a big group of people here today, so we're excited to have you present today. I'll turn the time over to you. Ransom, for some reason, it seems like your sound isn't working.
Oh, there it is.
There we go.
Yeah, I will iterate something else that Marche said. Before you act on any advice in today's seminar, make sure to check with a professional. There may be one little key thing about your situation that could derail a potential strategy or have unprecedented circumstances later on. Today's presentation is going to be about taxes in retirement. One thing we all love to do is reduce tax and grow our assets, right? So through this presentation, I'm going to show you how to disinherit Uncle Sam a little bit and still be very prudent about your investments and continuing to grow and make progress during retirement. I hear from a lot of clients from time to time that as they approach retirement or they're at the year they're going to retire, that they want to slow down completely. Well, the fact is these days we may live, another 25 to 35 years in retirement. So yes, we may need to take our foot off the gas a little bit, but we don't need to slow completely down. So some of the things I'll be covering today is a checklist for reducing taxes and growing assets. Detail on how to maximize your Social Security benefit, which I think is very important. It's a benefit that we have all paid for, and we need to make sure we're getting the most out of that we possibly can. And then a little detail on tax-free investing and how to potentially save in taxes in retirement. So it's kind of important to set the stage for where we are and kind of what happened in 2020. So the Secures Act was passed, or wasn't passed, it went into effect January 1st of 2020. And the reason I'm pointing this out is because it was the largest change in retirement law in history of the United States. It removed the cap for IRA contributions and also extended the time frame for your required minimum distribution. And a required minimum distribution is what the IRS makes you take out of your qualified retirement plans. 401ks, 403bs, SEP IRAs, simple IRAs, traditional IRAs. A Roth does not require a required minimum distribution. So that age was moved from 70 and a half to 72. And that's really beneficial. One thing that it did as well, it took away an old strategy that's been in play for a long time called a stretch IRA. And that's basically for non-spouse beneficiaries. But there's some workarounds and some things we can do there to make sure that the next generation doesn't spend all of their inheritance right away. So I'm going to talk about each one of these in detail as we go through. But this is essentially a checklist I wanted to provide. So it's important to analyze your portfolio. And again, I'll get into more detail on all of these. Kind of assess your income needs, right? What do I need in retirement? What does that look like? And then invest in a smart financial plan. I can't tell you how far a financial plan can take somebody. It's really the power of knowledge and knowing that what you're doing in the short term is also going to keep you on track in the long term as well. I believe in setting goals and investing in a manner to achieve those goals. And it really gives us a step-by-step path on how we should be handling financial complexities in our financial situation as life changes. So also, right, invest in a tax-free account like a Roth IRA. We'll talk more about that as well. And then reasonable withdrawals are always going to increase the longevity of your investment portfolio. You want to consume your investments at a reasonable rate. Now, there will be times where consumption is higher than others, and it's okay to step outside the normal distribution rates from time to time. We just can't do it consistently throughout retirement. So analyzing your portfolio, what does that mean, right? We all hear that term all the time. Analyze your portfolio, know your investments. Well, it's really the relationship between risk and reward. You want to make sure that you're getting rewarded for the amount of risk you're taking. Sometimes it doesn't make any sense to take additional risk because there's no additional reward to be had. I think it's really important to understand geographically where you're invested and what sectors of the economy you're invested in, and then to monitor those things against a benchmark or against some way of deciding, yes, I'm successful, or no, I'm not. That'll lead you to be able to change course and take other actions. Expenses are extremely important, and I've got a quote in here later, but it's not necessarily about how much money you make, it's about how much you get to keep. And so by really understanding the expense ratios within the investments that you're in will help you keep more money in your back pocket and not someone else's. You have to understand the relationship between stocks and bonds and the risk that there is there, right? It's kind of like the tortoise and the hare. The hare is going to be our stocks, and it's going to run all over the place. It's going to go up and down, and our bonds are going to be, you know, the tortoise that's going to slowly and steadily get there over time. Nothing fun, nothing to write home about, pretty boring actually, but I love bonds. So it's really the combination of the two, and the less risky our assets are, the less return we get. But at the same time, with a financial plan, you may not need to hit a home run, and you may not need a 10% rate of return to accomplish your goals and the things you want to do. So really understanding that relationship is key. And then again, just the financial plan, right? Goals is extremely important. I like to break those down into needs, wants, and wishes. The needs are the things that we have to have in retirement: basic living expenses and healthcare costs. The wants are the things we want to do. We want to travel. We want to buy a new car every 3 years. We want to help our grandson with tuition, whatever the case may be. And then the wishes are, if everything's in perfect alignment, we wish we could have a mountain house or maybe a lake home, or rebuild a 1969 fastback Mustang. Whatever your wish is, right, we can plan for that and make sure that there's resources available to do just that. Again, losses are pretty detrimental to a portfolio. And I'm going to say something that I think is contrary to what you've learned and what you've heard for your entire life. But as we approach retirement, or we're in retirement, losses are far more impactful than gains will ever be in your portfolio. And to kind of, show this, right, let's say we start out with $1 million. You lose 50% of that money 1 year. Now you're left with $500,000. So if you have a 50% gain, right, you're still 25% down. You're not back to even yet. And that's kind of contrary to most people's logical thinking, right? Human nature. If we have 100% gain, right, we're back to even because we gained 100% of that $500,000. So you can see how more impactful the gains, the losses are than the gains. And it's really just about being a good steward of your assets and understanding that relationship between risk and reward. So income, right? We all have to have it. We have to have cash flow in retirement. And in my opinion, the way you use your assets in retirement is really more important than the way you accumulate them. Because the ultimate goal, right, is to run out of breath and then run out of money. And if we don't do that, we're going to have to move back in with our kids, and I'm sure they don't want that, and I definitely don't want that for myself. But look at your average annual expenses, right? Let's calculate Social Security, any pension income that's out there, no matter how small. And these are all sources of income. Also look at any potential rental income you have from commercial property, single family, multi-family homes, trust, oil and gas royalties, anything that's out there. I often get asked the question about inheritance. Ransom, should we count inheritance? Well, I think that's the icing on the cake, but I don't want to necessarily it be the cake itself. So we will consider that, but the person you're wanting to receive that inheritance from may live another 20 years, and that's just wishful thinking. So I do like to account for it, but I don't like to count on it. And again, understanding how your RMDs work, because at age 72 now, that's going to be a piece of income that's coming in, and we don't want that to derail our overall tax strategy as well, and it often can. Also, I'll encourage people, most clients don't really need to spend their required minimum distribution, but I do believe that all work and no fun is pretty dull. So spend some of it and have some fun and do some things that you wouldn't normally do, but then try to have the mindset of reinvesting some of that required minimum distribution for the future as well. So here we are again, right? Required minimum distribution. Again, it's at 72. You have to take a required distribution out of all of your IRAs, SEP IRAs, simple IRAs, 401ks, 403bs, 457 plans, anything that's basically a qualified pre-tax account. Government IRS makes you take money out of it. The withdrawals usually start at about 3.64% and gradually increase over time. And the idea is if the balance is going down, the percentage increases so that your distribution stays relatively the same. Kind of a nice steady source of income for people in retirement. One thing I will point out, the IRS is full of penalties and different odds and ends if you don't follow the rules and do exactly what they say. But the biggest penalty in the Internal Revenue Code is failure to take your RMD. And that penalty is actually 50% of the RMD balance. So if your RMD balance is $100,000 and you forget to take it for whatever reason, that penalty is $50,000. And the IRS does not mess around with that. I can promise you. It might take them 2 years to get back to you, but they don't mess around when it comes to their penalties. Social Security, right? How much are we going to get from Social Security? This is one of our sources of income in retirement, and it's important to understand it. So let's just take the middle column, average $75,000 annual income. At 62, which is early retirement, you would get about $1,800 out of your Social Security benefit. At age 66, which would be full retirement in this scenario, you would get about $2,400. Pretty big difference there. Then if you look and wait till age 70, you get a little over $3,000, almost $3,200 in benefit. It really depends on your situation, where you are, your cash flow, and other resources on should you take it at 62 or should you take it at 70. There's a right answer for everybody. We just have to take in all factors into consideration before really moving forward with that plan. This also shows just a difference, right, in how far your benefit goes and increases just based on a $2,000 a month benefit, right? At age 62, that's early, so you would get a little less. You would get about $1,500, and then at full retirement, you would get the $2,000, and then at 70, you get about $2,600 there. That's a huge increase, right? That's almost $14,000 a year difference, and that really can help make or break somebody's retirement and cash flow. So it's important just to understand how that dynamic works with you. One thing I do is I like to run through during my financial planning process a particular scenario with everyone, and this is Bill and Sally Sample. They're two of my favorite clients because I don't ever get phone calls from them. There's never an emergency. No, I'm just kidding. They're good people though. So with them, right, we look at the repercussions in this first column that's labeled number 1 at taking it at 66, right? And so they still have a 99% probability of success. Their total benefit's going to be about 1.9 million, and I don't like to plan on life expectancies to be age 100. I don't think that's practical. I go by your actuarial life expectancy. For a male that's 65 today, your life expectancy is about 92 years of age. For a female, it's about 94 years of age. And I'm sorry, guys, to tell you, the women are going to outlive us. So we have to make sure we take care of them and get them set up to be in a nice position. So you look at, for example, age 62, which is column 2, it decreases their probability of success to 97. Still very high as far as the probability goes, but there are financial impacts for that, and it turns their lifetime benefit into 1.4 million. So from 1.9 to 1.4 is pretty significant. So let's move on down and look at the blue highlighted box, which is number 5. This is not the it actually is the highest gross amount for their lifetime. So they both wait till age 70. Now they both maxed out their Social Security, Bill and Sally both. They still have a 99% probability of success, but now their lifetime benefit is about almost 2.2 million, right, in total benefit. It may be a scenario where one spouse's Social Security is significantly higher or different than the other. And so if you look at the next column, part 6, this is where Billy takes his at $48,000 a year, Sally takes hers at $33,000 a year. This does decrease the overall benefit, but it allows them to have some cash flow from age 66 to age 70 when Billy collects his. Now, the key thing here is when Billy passes away, Sally will be able to completely claim his benefit as her own. She would drop hers and claim his. Now this puts her in a very favorable situation, and actually she'll be getting more out of that benefit than she would if she had waited till age 70. So very strategic and very complicated, but those are the things that we help clients figure out on a daily basis. Taxes, right? Will taxes go up? I think it's inevitable, and this chart kind of helps with that. Historically, right, this is going back to World War I. You can see that in times during the U.S., we were north of 90% in taxes, and that's a lot. That's a lot to pay. It's a lot of work for me to do and very little benefit for me to get to keep. The nice thing about it is a lot of these events were pretty short-lived. And we have the Economic Recovery Tax Act from 81, and then the Tax Reform Act in 86, and then of course George W. Bush in his first term passed the Tax Reconciliation Act, which was some of the same benefits we still use today. Some of those benefits have sunsetted and we don't use them anymore. But the average maximum tax rate was 58%, and you can see that the average minimum rate was about 11%. Now in 2022, the max rate's 37 and the minimum rate is 10. So we are really at pretty low marginal tax rates, all things considered, and I think things may get a little more taxing for us. That's my joke. I wrote it. I apologize. So let's look at this. Here's the 2022 tax rates from the very bottom to the very top. And yes, there are some Medicare pops on top of that highest tax rate to bump you to about 41.2%. We won't get that granular today, but I do know it's out there. So this is from the Congressional Budget Office in future tax rates. So we can kind of see what that looks like. And then, of course, on the far side is 1960 to 63 tax rates, where things got to 87%. The Congressional Budget Office thinks we're going to wind up somewhere in the 63% area. And I'm not saying this to scare anybody. I'm saying this to encourage you to do some planning and prepare yourself for if this happens. And as a financial planner, right, I always want to plan for the worst and hope for the best. And so this really hopefully will wake some people up and know that higher taxes may possibly be coming. And if we're at a pretty low bracket now, it just makes sense to maybe do some Roth conversions or some tax-free planning for the future. So some tax deductions, right, that are out there. We all have the standard deduction, you know, 12,950 if you're single, and then of course, you know, 25,900 married filing jointly. Additional deductions for people that are 65 and plus, the way to save a little additional tax revenue in retirement is, you know, the standard deduction, and then you've got your unmarried and widowed individuals that can claim a different deduction, and then of course a standard deduction for married filing jointly in retirement, age 65 plus, is an additional $2,800. So itemized deductions, typically only 2% of Americans itemize deductions. If you have medical expenses that exceed 7.5% of your adjusted gross income, you can itemize those deductions. It's really nice. I like that a lot. Home mortgage interest on a mortgage that's less than 750 can be deducted. Here in the state of Texas, we have pretty high property tax that can be deducted as well. And then charitable contributions are a really nice way to be able to receive additional deductions. And you can give away all or part of your required minimum distribution to a charity as well, but it does matter the type of asset you give to a charity, and then also the type of charity receiving that. It needs to be a qualified charity, typically a 501c3 nonprofit type of organization, to qualify for the maximum benefit there. And you also need to give either stock or cash in order to benefit there. You know, a lot of charities don't want your used, you know, Buick Capri that's in the backyard with no tires on it, that you're not going to get a huge benefit for donating that. Yes, you might get rid of it and get that junk cleared out of your yard, but not a lot of financial impact there to you or the charity. So be careful about what things you gift and understand that as well. Long-term capital gains. This is a thing that has been on the chopping block, if you will, for the last few years. I don't know how many times I've heard rumors about, oh, capital gains is going away. And so what was it before capital gains came into play? Earlier, I had mentioned the Tax Reconciliation Act, which did a lot of stuff for the U.S. during that time. But one thing it did was it brought the investment market down to your normal person. And beforehand, any profits and any gains I had in stocks were taxed as ordinary income. So if I was in the 28% bracket and had earnings in the stock market, I would have to pay 28% taxes on that gain. Well, capital gains rule comes along and says, okay, if you make, we'll just stick with married filing jointly, right? If you make $83,000 and less, you pay no capital gains. If you make over that, between $83,000 and $517,000, you pay 15%. So what that did, that encouraged lots of people that weren't typically investors to invest and invest money into the economy and into the markets, and it was really advantageous for the American economy. Now, if you make over $517,000, you're in the 20% capital gains, and this 20% nuance piece is fairly new. It's been around for a little while, but you know, just know it's really a nice thing to be able to have some reprise on this and not be taxed at ordinary income when you do have gains. And this includes, you know, selling of a business, selling of a stock, anything that appreciates and you have capital gains over cost basis, this applies to. One quick thing I'll throw out there, since the pandemic, trading cards like baseball cards and football cards and comic books have really made a roaring comeback. When you sell a collectible for a profit, it's taxed at 28%. And that is the collectibles tax rate. So just be aware of that too. You know, I would love to sell a basketball card or a baseball card for a lot of money, but you know, 28% of that has to go back to Uncle Sam. So just be aware of those differences. This is the quote that I mentioned earlier about investing in a smart financial plan. I can't tell you how powerful a financial plan is. It's really a roadmap, right? And if, you know, we were going from Texas to California, we know that we have to point our car in a westerly direction, right? But that's not the most efficient way to get there. What we would do these days is pull up our phone, look for attractions and gas stations and all kinds of fun stuff to do in between here and there. And we would have a roadmap on how to get there and how to get there in the most efficient manner possible. That's what a financial plan is for your financial life, really. And think about this too, on your trip from Texas to California, there's going to be some changes come your way. There's going to be some detours and some construction. And being able to deal with those financial complexities as they come at you is key to long-term success. But this quote is one of my favorite, right? It's not how much you make, but how much money you keep, how hard it works for you, and how many generations get to keep it. You think about that for a minute. That's very, very powerful. Not only can you do better for yourself, you can do better for future generations, and really make a huge difference in people's lives on an ongoing basis. And that's really powerful. Give me 1 second. There we go, having technical difficulties. Okay, so saving for retirement, right? I like to put these 3 buckets up here so you understand the difference. And really, it's like a 3-legged stool, right? Without one of these legs, your stool is going to fall over and you're not going to be as successful as you would have been otherwise. But you can save in a taxable account, right? There's no contribution limits and there's no tax deductions for investing in a taxable account. A pre-tax account, which would be a 401k, IRA, the SEPs, the Simples, all of those, you are limited on contributions based on what the account is, and there are specific limits to that. So you have to understand if what you're doing is the right thing for you. Are you going to be able to accumulate enough in the end? And then you can also do a Roth 401k. In your current 401k, most 401ks do have a Roth component to them. One thing it will do, though, is it will decrease your monthly cash flow because the Roth contributions come out after tax instead of before tax. So it does have a little larger implication than making pre-tax contributions. Just be aware of that. And then a Roth IRA is the other side of that too. And yes, it has contribution limits, no limits on withdrawals as long as you meet a few rules. But it's important, right, to maximize your contributions to your after tax, your before tax, and also to have that third leg out there and be investing in taxable accounts at the same time. One question I put in here that I often get is that, I work and my wife stays at home. We can't do anything for her because she doesn't have a 401k or anything of that nature. Well, you can do a spousal contribution to a traditional IRA or a Roth IRA, and being able to save money for her on that side as well. So you can still do those things, and you probably should. So a Roth IRA, right? You've heard me mention that, and I don't like to just throw out, industry jargon and slangs. I like to explain what they are, and that way everybody understands. So currently, you can put $6,000 per person into a Roth IRA. You get a catch-up provision of $1,000 if you are age 50 or older, and that's in the same calendar year as the taxable year. Your contributions are not tax deductible, so there's no immediate benefit from a tax perspective for making a Roth contribution. You are phased out from being able to contribute to a Roth for married filing jointly between $204,000 and $214,000 a year. For single filers, between $129 and $144 a year. The most powerful thing, right, is that there's no required minimum distributions. No one's ever going to force you to take money out of this account, out of a Roth IRA. You decide when you take distributions and you decide what you need them for. You do have to be 59 and a half and meet a 5-year rule as well, but those are easily done. And the neat thing is too, right, that this can provide for tax-free inheritance at the same time, and there's no way to transfer assets tax-free outside of a life insurance plan than to do it with the Roth IRA. This breaks down just a little bit more of the detail. I probably overdid it here, but I think it's important to understand a couple of things. So when you look at a traditional IRA, you have until April 15th of the next year to make your contribution. So if I wanted to make a contribution in April of 2023 for 2022, I can do that. You cannot do that in a 401k. That's based on December 31st. So any money as an employee that I want to put in, I've got to do it before December 31st. Same thing with the Roth. It's a April 15th time frame, not December 31st, but the 401k and 403b Roth piece is December 31st. So you can think of it this way. As an employee, I have until December 31st to put what money I want in my 401k in it. And then my employer has until their tax deadline to put my match in it, the employer side instead of the employee side. And then you can do up until April 15th on traditional IRAs and Roth IRAs. People get confused and always get asked that question. Oh, I have to hurry up and do this before December 31st. Well, no, actually you have until April 15th. So just kind of understanding those time frames is helpful. So there's a strategy out there, right, called a laddered conversion for a Roth. And what this does is it essentially takes money from your traditional IRA, 401k, 403b, all your pre-tax accounts, and incrementally converts it into Roth money. And the only way to convert it is to pay the tax on that money and then put that money into the Roth IRA. So earlier when I was mentioning the $6,000 contribution and the $1,000 catch-up, excuse me, that's a contribution. This is a conversion. So they're two completely different things. We can contribute up to those limits and we can convert. There is no limit. So, however, I probably don't want to convert $500,000 all in 1 year because of the huge tax penalty or huge tax liability that I will have to pay. So to kind of show this and extrapolate this out just a little bit, this is a gentleman who is, has about a $760,000 IRA, makes about $166,000 a year. We want to convert money into a Roth. So how do we do that? Well, we do it incrementally over a period of time. That way the tax liability that I'm paying is not so great up front, and I get to stretch that out over a few years. But you can see in the first column, the Roth conversion, we're pretty heavily focused in the first 4 years on that conversion and getting that money converted so that it can be working and gaining ground for this individual. So you can see the IRA balance starts to drop. And that's pretty important because when we get to 72, which is the first line of the RMD that shows $4,094, that's his required minimum distribution. Because we have depleted the traditional IRA so much, the RMD is now really not a huge impactful factor, which decreases taxes and in the long run is significantly beneficial. And so we stick on this same trajectory for the first few years, and then we convert, a little less, around 35,000 as time goes. But what this does, though, it essentially has a tax savings of about $478,000, and total retirement and inheritance tax savings is about $718,000. Now, I know this scenario is a little extreme and quite a bit of information. Really, the thing I want you to get from this is just how impactful doing Roth conversions over time can be to the bottom line and how it can help over time. And you think about this too, this last line down here at the bottom that says 1.4 million, 1,453,953, that is now your Roth balance. And we didn't figure any, massive rate of return here. We were very conservative. But now you can leave that tax-free to a non-spouse beneficiary, and that's extremely powerful. This is another example, not so quite large. This would be somebody with a $500,000 IRA and or 403b that we rolled over to an IRA, and it just shows that over a period of time, the yellow bars are the Roth conversion piece. The blue bars are what money we're getting from Social Security, and the green are the RMDs, the required minimum distributions. And all we're trying to do in this scenario is reduce the required minimum distributions, convert some of that money to Roth, and to really just give this individual some flexibility in retirement, right? When you think about long-term success, it really comes down to having options and being flexible and not ever being painted into a corner because you don't have any choices. And so this just shows that, and the savings to this gentleman over his estimated lifetime was $209,000. So this is really a more real life, example. And I just thought I wanted to show both of those. So I appreciate that. So what did we learn today? Right? How to potentially save a couple $100,000 in taxes by converting to a Roth IRA. And who doesn't want to do that? I do. I don't mind paying my fair share, but I don't want to give any more than I have to in taxes. Strategies on how to eliminate or heavily reduce taxes. How to get about an extra $13,000, $14,000 out of Social Security, just depending on the strategy that's best fit for your situation. And really important to avoid that 50% penalty from the IRS on not doing your required minimum distribution correctly. And then just a little bit about the Secure Act and how it impacts you. One thing I will tell you about that 50% penalty, it's an aggregate number of all of your IRAs, 403Bs, 401Ks, and that number is assessed on an aggregate balance. And if you forget one, you don't include it, then you're subject to that penalty. And I've had people in the past that I've talked to have forgotten about an old 401k that they had at a job, they had 15 years ago. All of that factors in. And so sometimes consolidation, working with a professional and just understanding all the moving parts and pieces can be extremely useful down the road.
All right, we're going to go ahead and open up to questions. I already had some come in. So I will say, folks, go ahead and put your questions in while we're doing this, and we're happy to add them to our list there. So here we go with the first one. Just a second, let me get it up on my screen here. All right. So this is a question about itemizing deductions from medical expenses. Can you go over that percentage again? And then the question is, if you have a higher income, then you can deduct more relating to medical expenses. Is that correct?
Yeah, so the income is not necessarily going to allow you to deduct more or less. So let's just say we have a $250,000 adjusted gross income on that year, right? So 7.5% of that has to be charged in medical expenses. And as someone that's working for yourself or self-employed, you can take your insurance amount you're spending there as part of that deduction. You can't do the whole thing, but you can do part of it. And then if you had, like a high deductible policy with $10,000 out of pocket, and you spent that, and then there's some ongoing physical therapy or some physical rehab after that you had to pay for out of pocket as well, all those things can add up and be able to be itemized and deducted. But as long as the amount you're trying to deduct or the amount you spent is over 7.5% of adjusted gross income, it qualifies as an itemized deduction. And actually, the more income you have, the harder it's going to be to meet that 7.5% threshold.
All right, thank you so much. Here's another question that we got. So you mentioned there's a 5-year rule you have to meet for withdrawing from a Roth IRA. Can you go a little more into that?
Yeah, so there's the 59.5 rule, which if you meet that, prevents you from paying a 10% penalty on withdrawals. Then you got to think about it too. The Roth IRA, the traditional IRA, they're all retirement accounts. So the IRS and the government doesn't want you taking money out of that thing at 35 or 40. So they put the 59.5-year requirement on that. Now, if I start a Roth IRA at 59, I can't take money out at 59.5 because I haven't met the 5-year rule yet. So the contributions that I put in are mine, and I can take those if I want to, as long as I'm 59.5. It's the earnings piece of what that money made that I can't touch for 5 years. So it's a little complex, but easy to stick to the rules when you look at it from a big picture standpoint. So if you haven't had a Roth IRA for 5 years, make sure you contact a professional and you get a systematic way to take distributions out, and you're not taking earnings and cost basis out of it, that you're doing it the right way so that you don't incur that 10% penalty.
All right, thank you so much. I have another question about the Roth. So we went over the contribution limits. And if you can repeat those again, in fact, I'll put the slide back up. Oh, actually, Ransom, you have the slides. If you can put that back up about the, yeah, oh, there it is, the contribution limits. The question is the income limit for a Roth just for individual Roths, or what about a company Roth?
Yeah, so when a Roth is an individual, right? So IRA stands for Individual Retirement Arrangement. So if it's mine and not associated with a company, these limits apply. The $6,000 per person, and then the $1,000 catch-up provision at age 50 and older. When a Roth is associated with an employer-sponsored plan, like a 401k, there's no limit to what you can put into it, except for you. So as an employee, right? So let me kind of start this over. So a 401k has two sides to it. It has an employee side and an employer side. The employee can put in this year, the employee, me as the employee, can put in $20,500. Okay, that can go anywhere you want, to the pre-tax side, the after-tax side, whatever the case may be. Now know this though, your company cannot match Roth IRA dollars. So any match that you get, like a 3% match or a 5% match, you have to fulfill that match on the pre-tax side, and then the dollars that the company gives you are also going to be pre-tax and not after-tax. So again, make sure that you're contributing enough money to the traditional side, the pre-tax side, to get the match, and then anything additional can go to the Roth. But just make sure you're not leaving any money on the table when it comes to company matches and things of that nature. You want to make sure you're taking full benefit of that. And again, when you contribute to the Roth side in a 401k, it will dramatically decrease your cash flow for that pay period, because the other contributions are coming out before tax, and these Roth contributions will come out after tax. So it's not necessarily a double whammy, but it's a little less cash than what you're used to your paycheck being. So just prepare yourself for that. Oh, Marcia, I think you're on mute.
Oh, sorry about that. I just said, go ahead and keep the questions coming, folks. I have a few more that are lined up, but we'll keep taking them as we can here. If you have two IRAs, can you withdraw enough from one to cover the RMD for both accounts?
Yes, you can. You definitely can. The dollar amounts are aggregated for calculating the percentage that comes out. The IRS doesn't care where you take it from, as long as you take it, and they get their tax money out of it. So you could have a very large IRA and a small IRA, and you can take all your distributions out of the small one until it's used up, and then you can just take them out of the large one. Really doesn't matter how you do it there, as long as the dollar amount at the end of the year is correct and the taxes are correct. They don't care where it comes from.
All right, another great question.
Yeah, absolutely.
All right, here's a good, just kind of nuts and bolts question. How long does it take to do a Roth conversion with a financial advisor?
Yeah, it really just depends. A lot of things go into consideration when we're looking at that. So really, your appetite for taxes, your ability and money on the sidelines to pay those taxes. What I don't want to do is take out extra money from a traditional IRA to pay the taxes to go into a Roth. You've kind of impeded your progress by doing so. So typically, what I like to do is in the example that I had Oh, I think Marcia, you took controls back. So hold on, let me see if I can pull this up real quick.
Is it this one you're talking about?
Yeah, here it is, right here.
Okay.
So this is a great example because the blue line running from left to right is our 10% bracket, and then we have the green line that's intersecting the yellow lines. That's the next bracket, and then the purple line that's at the very top of this chart, that's our 24% bracket. So what I did in this scenario is we went on ahead and operated on a conversion standpoint to right at the very edge of the 24% bracket. We didn't want to step over that bracket because that was uncomfortable for the client, and it just didn't make sense to. And so we operate right up to the edge of that and then convert over a period of time. And here, you can see the difference in between what the RMD is, the green rectangle. The first 4 years is when he's taking his, and then in that 5th year, which would be 2029, she started taking hers. And so that really pushed them over the amount of tax they were comfortable paying. So it really just depends on the aggregate situation, the ages of the client, the appetite for tax, how much cash reserves they have to pay the tax. And don't forget, right, we can take gains out of a taxable account going back to those 3 buckets, the taxable, the traditional IRA, and the Roth IRA. We can take taxable gains out of a taxable account, pay taxes at 15% in order to help pay the tax liability. So there are lots of advantageous ways to get there. It really just depends on what tools we have available and what our time frame is. I even have clients that are close to 80 years old that are doing Roth conversions because they see the long-term impact of those tax dollars if they live another 10 years. And then plus, not to mention too, right, the tax-free inheritance is huge. And most of the time when you get to 80, we're pretty well set, and you know what things look like and what they are. And if there's extra money and you want to be able to leave it behind, leaving it tax-free is a great way to do it. That way you kind of leave the cup full instead of half empty when you pass. So, a lot of different factors go in there, and I know that's probably not the answer you wanted, but it just depends. That's why a financial plan can be so powerful, and just sitting down with somebody and understanding your situation, because we're all different. We all have different needs and we all have different circumstances. So extremely powerful to be able to understand the nuances of your situation and picking what's best for you and your family.
So I have a couple more questions that came in, but first of all, a follow-up to what you said right there. To be accurate, do you pay tax on the RMD calculated at the end of the calendar year, or the RMD calculated on your birthday, for example, at age 72 and each year thereafter?
So the way the new RMD is written is that you have to take the RMD within the calendar year that you turn 72. So you will have to then pay it by December 31st before that year end. And then after that, you'll be on the April timeframe. So the old trick was, to tell you the truth, was when it was 70 and a half, if you turned 70 and a half in, let's say, November, okay, the way the law read is that you have to take your first required minimum distribution before April 15th of the year you turn 70 and a half. So you would not take it in November because you could wait till April. But then what the IRS didn't tell you is if you took it in April, you've got to turn around and take another one in December, because April was for the prior year and the one you're taking in December is for the current year. So then you've doubled up on your tax liability and shot yourself in the foot. The IRS loved it. You're not going to like it. Now it's a little simpler than that, where just in the same calendar year that you turn 72, you've got to take that distribution and then just pay the taxes. And it's at ordinary income as well. So if I've got money coming in from a pension, Social Security, some rental income, and then I'm taking this required minimum distribution, that's added to the aggregate to figure my adjusted gross income and what percentage of ordinary income I have to pay on that required minimum distribution. Again, that's why doing the conversions is even more powerful still, because once we pay the taxes on it, we're done. We never have to revisit that issue. But good question, though. You're definitely a thinker, that's for sure.
All right. I have one more question, and I think we're going to have to close the questions, but I do want to tell people if they want to put more questions in, we're happy to take those and save those and reach out to you after today's event to make sure those get addressed. So shouldn't everyone maximize their Social Security benefits by deferring to age 70? When would I take my benefits early?
Yeah, I've always been a big fan of again, understanding the individual situation, where they're at. Some people, to be quite frank with you, didn't save enough and didn't do enough during their accumulation period. And so that might warrant taking it early at 62. There may just not be any other sources of cash flow. And so it really, again, just depends on the individual situation and what they're doing. We had a client a couple of months ago who we found out had been divorced for 20 some odd years, but was married for 15 years. And so, we filed for benefits on her husband, and prevented her from taking her benefit early, which was nice. So she gets to kind of ride her benefit, let it coast along and accumulate and get as large as it can, while we're taking his benefit, because they're married for longer than 10 years. So it just depends. I've had clients take it at 62, and then I've had clients wait till 70. There's really no right or wrong answer. It's just what's best for your situation.
And I suppose that'd be exactly why you would want to run the numbers on that scenario, kind of like you had in that example. I think I'll pop that up again so people can see that. That's a really good question. And I have one more question that I want to get in here. At what point do you calculate the RMD, and maybe just a compound to that? How is RMD calculated? So when is it calculated and how is it calculated?
Yeah, good question. So there's a table that the IRS has, right? And I'm sure they have a table for everything. But it is the normal life expectancy RMD table, and there's two different tables actually. There's one for people and their spouses that are within 10 years of the same age, and then there's another chart for people with spouses that are more than 10 years difference in age. And so what we go by is the December 31st balance in the account is the dollar value that we use to calculate the RMD. And if you, it's a divisor table. So if you have a $225,000 IRA at that point, and you have to divide by 27.8 to get your RMD for that first year. And then each year, the divisor actually increases so that the numerator stays the same. So it goes back to that scenario where the account balance is decreasing, but the divisor is increasing so that the distribution stays level. Believe me, the IRS put more than a day and a half of thought into this when they figured this out. It's definitely advantageous for them. And again, the RMD is not a huge deal. Typically about 3.5% of your total balance each year in the IRA. But again, if you can do conversions, convert that money to a Roth, and then really minimize the overall required minimum distribution to not be so impactful on your adjusted gross income and your tax situation, it's really nice. And think about this too, right? And I'll make this really quick. You're in retirement, you're 80 years old, and you want to go on a cruise. and you want to take the whole family with you, and it's going to cost $60,000 to do it. Well, do you sell some investments and pay the 15-20% capital gains tax on them to generate the money to do that? Or do you reach into your Roth IRA and pay no taxes and take the whole family and have a blast and not worry about Uncle Sam at all? Well, you take the tax-free money and have a blast. And so being able to have tax-free money in retirement, I can't tell you how useful that is. It's like opening up the toolbox, and the tool you need is right there on top every single time. That's how powerful a Roth IRA can be.
Well, folks, I'm sorry we have to end things here, but we do want to give you your day back. And I want to thank everyone for your questions. I did get a couple more questions in here that we weren't able to answer. And we'll make, if you can just go ahead and put in your contact information in the chat, I'll make sure to save that and get it to our team that can reach out to you after today's event. Well, once again, I want to thank Ransom for being here and for the organizations that have made this webinar possible today. For our attendees, thank you so much for attending. Look for an email soon with a link to the replay of this event, and you're welcome to share that with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners is committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Thanks, everyone. Bye-bye.